What is up, guys and gals? Welcome back to another Loose Ventures video. I want to talk about my value investing strategy, the strategy that I consider my core trading strategy, at least in these markets. And I thought it'd be a good idea to walk through my process. Hopefully, I can share all the details of that and help you develop your own process. There are a lot of things that I have to cover. I'll try not to make this video too long. And for the sake of conciseness, I'm going to assume that everyone watching understands at least the basics of investing and has a bit of knowledge of equity multiples and other financial terms. If you don't understand some of the terms that I use, feel free to ask in the comments what they mean, how to apply them, or if you don't feel like waiting for me to respond, Investopedia.com is a great free resource to learn more about pretty much everything I'm going to discuss in this video. There are other sources. Investopedia.com just tends to cover pretty much everything. So, that said, let's get started. So first, I'll give an overview of value investing, and I'll pose an important question, perhaps that many of you have asked previously. What is value investing, and does it work? So, value investing refers to buying stocks at a relatively low price based on, valuation. The primary question that I need to answer as a value investor is, how is the market valuing each dollar of real value or profit the company is generating and is expected to generate in the future? At a high level, my style is to compare potential returns and risks of different companies and invest in the most attractive opportunities with greater upside than downside potential, or as a very esteemed deep value investor well put it, stocks with asymmetrical return to risk. I'm always focused on the occurrence of a catalyst, as this is typically what drives excess returns. GameStop is a classic example. Without a catalyst that isn't already priced in, mind you, a stock price may never appreciate the way you think it should. This, I believe, and I'm sure all other investors believe, particularly value investors, is crucial to the investing process and finding companies that are actually undervalued but will appreciate in value over time as those catalysts occur specifically. Personally, I don't care about endless DCF models and 5 to 10 year valuations, and frankly, neither does the market. The markets reward stocks that prove themselves over time and perform better than anticipated. Sometimes the markets get that wrong, right? But overall, I need to make sure I know something that the markets don't, or if perhaps maybe the markets are underestimating the chance for the occurrence of a redeeming catalyst for a struggling company. And this does happen plenty of times. That's why value investing is still something that investors do. So to answer the question, yes, value investing works. The broad indices and clickbait headlines that you might see criticizing value investing don't accurately represent value investing results. Value investing hedge funds tend to outperform the value ETFs by a significant margin over the long term. That's not a coincidence. To get multi-baggers specifically, you're going to have to take greater risk. Sometimes you'll find plays that don't seem to have as much risk as the markets imply, but you'll find that more often than not, you'll be fighting the valuation that the markets have decided on. So in this context, value investing requires very good due diligence and sometimes a lot of patience. Overall, I think it always comes down to liquidity and leverage, if I had to point to a few key criteria for value investing in general. This is particularly evident in cigar butts and companies trading at a steep, or rather, companies that trade at a steep discount to book value. The question I need to answer here is, what's the real value of each $1 on the balance sheet? What can a company do with $1 of cash flow? How much can they grow that $1 of cash flow? This is nearly impossible to know when there's no track record for certain companies. So I tend to stay away from recent IPOs and SPACs, which historically have never entered the market at a good value or a value price. So, what is my time horizon? For me, it's about 3 to 24 months. That probably seems to be somewhat of a broad range. I don't know how much that helps, but I would point out that I do want to limit myself to that 24-month time frame because it's so hard to predict anything that's going to happen in the future. So I prefer the short term, but typical value investing, you're not going to make returns within a couple days, within a few weeks, even within a few months. A lot of times it's going to take it, maybe a year or longer. So for me, that 3 to 24 month time frame, it kind of gives a sweet spot for, things can sort of be predicted within that time frame, and I don't have to try to predict too far out. So in general, I look for catalysts that are either likely to occur within that time frame, or catalysts that, if they occur, maybe there's a lower chance of those catalysts occurring, there could be massive upside potential. I would consider the former, the likely to occur catalyst, relatively speaking, safer plays, and the latter, the catalysts that maybe have much greater upside but are unlikely to occur, as riskier plays. Next, let's talk about screening. So I'm always screening for plays. It's a nonstop process for me. Stock prices are going to change, and so are valuations. So I try to pay constant attention to at least a few hundred stocks from a high level. That sounds like a lot, but I want to emphasize the high level part. And once you have a good screening process and you're fairly systematic with that part, you'll find it becomes a lot easier, becomes a lot faster than it would seem. I use all sorts of methods, which you're bound to do at some point as well. And I primarily rely on my own watch list that I continue to add stocks to over time. At some point, any stock could be a potential play, so I don't ever forget about a stock just because I don't like the price it's trading at today. So a few examples for stocks or the screening process, if you will. One of my favorite screeners is FinViz. So here you got a nice screener where you can filter out a good amount of, or you can screen for pretty specific metrics. So you might want to look for stocks that are trading, I don't know, under 1 times price to book value. It's going to give you a whole lot, right? So maybe you want to stick to just the US. Maybe you want, let's see, I don't know, you want insider ownership over 10%, maybe. So now we're bringing it down to, let's see, we got about 10 pages of stocks here. Maybe you want to look at price to cash and say that's under 5. I bet that's going to narrow it down. Okay, now we're getting even more specific. And I don't know, let's see, what else can we add here? Let's say we want stocks that have, is there sales growth? I know sales growth is here somewhere. Sales growth past 5 years. Maybe we're going to look at, let's say, over 25%. That's a pretty good screener, right? And from here, there are only 10 stocks, really. So that's a pretty specific screener, I would say. So from here, at this point, you can kind of dive in, and maybe these are the metrics you decide on. I'm just, just for speaking purposes, these are just a few metrics that I might look at from time to time. But I like to start off very specific, and then if I don't find what I'm looking for, then I'll kind of go a little more loose on some of these metrics, like say, okay, I don't need insider ownership. That opens it up a lot, right? So, and then maybe I can open up to different countries, so on and so forth. But this is just a good example of how you can screen, use FinViz to screen for specific metrics based on your preferences. So this is one way I do it. I primarily keep my watch list here, which if I open this up real quick, you can see that I have at least a couple hundred. So, yeah, I got quite a bit of stocks in my personal watch list. And here and there, and I got a few different watch lists, as you can see at the tabs on the bottom. But yeah, a lot of these I mark as hold, and every now and then when markets fall, prices change, I might open this watch list back up, like just the same way I just did, and kind of revisit the stocks that weren't a buy previously, because maybe they are now. So I guess these are, let's see, if I had to trim it down, I would say these are the stocks that I'm either long or considering building positions in. So this is kind of my watch list. This is kind of how I prefer to screen for stocks, just use my own watch list. But again, if I run out of stocks, or if I need to add more, say I only had a couple stocks left, right? Then I'll go to something like FinViz Screener, and I'll kind of mess with the metrics that I can use to screen for new stocks, new plays. So this is part of the screening process for me. Another way I'll screen for stocks, and sort of acts as a check, is I'll use ticker.com, which is, by the way, FinViz, it's free to use. Ticker.com is free. I believe you need an account for ticker.com, but they won't charge you, and you can get plenty of information. For me, it's adequate for what I need. So if we wanted to look at Apple, one way I might screen, or let's not make it so easy. Let's look at, I don't know, Big Lots. Oh, whoops. So look at Big Lots. Maybe I'll look at estimates first, and I'll see, okay, what does it look like going forward? So this fiscal year ending January of next year looks like they're expecting a decline in revenue. So this one, immediately I would say, okay, what's going on here? This is going to require some deeper digging. They only have 2% revenue growth next year, and some of their metrics don't look that ideal to me. So maybe I take a glance at other financials. I look at their valuations. All this you can see right here. So that's why I like ticker.com. But you can look at all these things pretty quickly, and as a result, this is a pretty important part of my screening process. And I can look at financials. I can look at valuations, projections very quickly, and determine if a stock might be an interesting candidate for my portfolio. So yeah, ticker.com, FinViz Screener. Those are two. We'll say I probably use ticker.com all the time, and then FinViz is if I'm sort of running out of stocks to look at, so to speak. So let's see what else. Overall, I look at current and forward multiples. So just looking at ticker, we'll go to valuation. So here you have like next 12-month multiples, last 12-month multiples right here. So I'll look at both of these, and I'll particularly look at revenue growth, which I mentioned, debt to EBITDA, leverage, and free cash flow. And overall, I don't rule out any industries, even if I don't understand them too much, since value really can be found anywhere. And I'll go into those multiples a little bit more in a bit. Another thing I look at, part of the screening process, very important part for me, is I'll look at stock-based compensation. So say Big Loss doesn't look too bad, 24 million versus 5.8 billion in sales over the past 12 months. So let's look at one that I know is really high, Airbnb. So if I look at Airbnb and I look at stock-based compensation, these numbers are pretty big. 879 million, 900 million for the past 12 months and the prior year, respectively. And then we hit a big 3 billion in 2020 when they IPO'd. So in this case, this is just too damn high. 3 billion in 2020 versus 3.4 billion in sales. That's pretty ridiculous to me. So this company, and it came down a lot over the past year. In 2021, about 900, 800 something billion, right? Or million. But it's still really high. So to me, if stock-based compensation is above 5% of revenue, I automatically become suspicious. If it's higher than 10%, I'm probably done looking at the stock. So a stock like Airbnb, I don't even to me, there's a fat chance it's trading at a value just looking at how much the management is paying themselves. Obviously, some of that stock-based compensation goes to employees, but overall, this is a big red flag to me. So I just skip the stock. I keep looking. I don't like companies with greedy management, and I I will avoid these companies like flat earthers. So another important part of the screening process. Another thing I'll look at is insider buying and selling. So let's see, DraftKings, no insider buying. So I'll use Open Insider, and let's see, what do we got? What's a good one to look at? Well, let's check Airbnb. So they just have selling. So I won't necessarily enter or exit a position based on insider transactions, but I do consider it an important factor. If I think a company is a decent value and the stock price has been tanking, but it seems management refuses to buy shares, I'm probably not touching the stock. So an example would be Pubmatic. I think Pubmatic is trading at a decent value. They're a growth stock. They're looking pretty nice. Just from a financials perspective, they're still growing. They say they're going to continue to grow no matter what happens with the economy. So everything seems good. However, management just isn't buying shares. So to me, that's a pretty big red flag. If the stock is so cheap, and I'll bring up the price chart real quick. So if the stock is so cheap to me, why doesn't it management see it as a relatively cheap stock? So you see Pubmatic, it hit a high of close to 70, about 70, and now it's trading at $18.44 as of today's close. So I'm just curious, when is management going to decide, hey, it might be a good time to load up on the shares of our own company? So this is a big deal to me. So even if I think the company looks great, they're still growing, high double-digit % growth in revenue for next year. Maybe the valuation, I look at this and it looks great. Balance sheet, everything looks fine. Stock-based compensation, it's a little high, but it's not that bad, right? Management is not buying the shares. What's the deal? So the way I see it, if the stock is so undervalued, which it could be, based on my valuation and based on the growth, right, and financials, everything considered, I don't mind waiting for a signal from insiders and hopefully the markets to buy, even if the stock moves up a good amount before I'm able to get in. So maybe it's very undervalued at $18 a share, and this stock is worth $30. And then management starts loading up on shares. The market suddenly say, hey, this looks like a good buy. Even if the stock price goes up to, say, $23 a share, I'm still thinking there's reasonable upside. There's another $7 on the table per my valuation, so to speak, right? So I don't mind waiting, even if the stock price moves up a bit while I'm waiting. And until I get that kind of signal on a stock like this, I'm not going to get FOMO. I'm not going to buy the stock. So aside from that, there are definitely times when insider selling will make me consider at least trimming a stock position. It really just depends. Overall, it really just depends on the amount, either way, buying or selling. And I typically look for transactions of at least $200,000 in size. Obviously, the greater the amount of insider transactions, the more attention I'll give to a stock. And I'll go over some of my screening process more thoroughly, or really as a whole. I'll try to touch on everything that I look at when screening for stocks, but I'll cover that in another video. And I'll also go over the resources that I rely on as well. So valuation, kind of touched on that already, but to go into further detail, when I've screened for stocks and I decided, okay, these stocks are worth looking into further, I looked at the initial multiples that I try to keep track of, and now it's time to do some good valuation, some good financial analysis. The way I'll do it is still technically part of the screening process. I do an initial valuation. So I come here and I look at forward estimates, just like I mentioned earlier, and I'll look at the relevant metrics like revenue growth, maybe enterprise value to EBITDA, maybe free cash flow yield. And that serves as sort of an initial filter. If none of these metrics check out, if none of them look good, I'm probably not going to look into the stock any further. unless I have some specific reason to do so. So I want to say about 98% of the time, if stocks don't pass this initial screening process, I'm not continuing my research. There are too many stocks to look at and probably plenty of other stocks trading at a good value. So I don't feel like I'm missing out. So the reason why I start with valuation essentially is to filter out stocks that are too expensive, or put another way, do not offer adequate potential returns versus the downside risk. I really don't mind missing out on overvalued high flyers, as those tend to do well based mostly on momentum. NVIDIA's a very good example of that. If I bring it up here and we look at the price chart, so we look at the past 5 years, there's some ridiculous movement, and I'm sure if maybe even in 2016, right, you're looking at NVIDIA and you're thinking maybe it's a good buy, and then it just starts going on a tear through 2021. It goes up to 320. And this whole time you're just thinking, wow, why didn't I buy it at 160, right? Or 130, whatever it's trading at. And for me, this is very strong momentum. They're beating on earnings, right? Everything looks great. But as soon as the market start to look shaky, the industry starts to look shaky, all that momentum is lost. And now you see a company like NVIDIA, the stock price, it has momentum, but now it's to the downside. So this tends to happen with stock prices in general. They have strong momentum moving up. The stronger it is, the likely it is to revert at some point. It's hard to time that. Personally, I don't mind if I miss out on these, because, I mean, look at the price now. It's 131, and unless I had gotten in and I sold at a very good price, no way I could have timed the top, right? But unless I had gotten in and sold at a good price, I'm basically back to where we were at least a year ago, you know? So this is one of the reasons. It's just an example of why I don't mind missing out on crazy stock price movements like these. I'd rather stick to valuation. And, you know, an example would be if a company that has grown revenue, say 25% for the past 3 years, unexpectedly lowers this year's revenue guidance from 25% to 15%, institutions and investors are probably going to reduce their exposure to that stock. As I mentioned, once that momentum ends, these high flyers tend to have momentum to the downside. So filtering out these stocks prevents me from getting FOMO and helps me focus on the real value plays that, mind you, could still outperform stocks like this. It's not unheard of. So DFE had good, he had good success with this type of investing, finding the multi-baggers, right? Even aside from GameStop. So that's another misconception, that you can't find those multi-baggers with value stocks. You totally can. You just might have to take higher risk. So overall, for valuation, I tend to focus on free cash flow yield. And that would be free cash flow divided by enterprise value. And this is my favorite metric, as it tells me specifically how much money a company is generating relative to its value. And this is hard cash, not GAAP, not net income, not earnings per share. So this is actual cash that the company is generating. Looking at this shows me the yield, which is how I prefer to compare returns of different companies. Warren Buffett does something similar by looking at operating income. So it's kind of like looking at a bond. How much is it yielding, right? That's how I'm looking at stocks. I also look at enterprise value to EBITDA. This is an industry standard, and price to book value for the cigar butts and otherwise distressed companies. There are other multiples that I reference, including enterprise value to sales, enterprise value to EBIT, and so on. Also, I always limit my position size to, I figured this is a good time to mention this, to 0.5%, maybe 1% until I learn more about the company. Once I do, I'll increase the position if everything checks out in a dollar cost averaging style. I think I have a pretty good process for filtering out poor investments, so I'm not too worried about entering a position before I've learned everything there is to know about a specific company. sort of as a disclaimer, I don't strictly adhere to multiples driven valuation, but I do rely heavily on them to give me an idea of what the market's opinion of a stock is. Overall, adhering to a good process is going to prevent analysis paralysis or excessive investing or trading. I don't feel like loading up on hundreds of stocks just because they all seem to have, some kind of upside. I'd rather focus on a smaller amount. That's just me personally. So once I've screened for stocks based on my multiples valuations, I'll conduct a financial analysis. Now, this part is probably pretty different for me versus a lot of other investors. I prefer to keep financial analysis as straightforward as possible, and because frankly, I don't have time to dive into the 10Ks of every single stock in the market, every potential value play. So I do rely on key metrics to give me a solid picture of how a company is performing and expected to perform in the future. However, if I do find an interesting stock where maybe the whole narrative isn't clear to me and maybe the valuation looks very compelling, maybe I have some other information, right from the get-go, maybe I'll probably dive into the 10K, the 10Qs, and do as much research as needed if I think it's going to be worth my time, if there's a lot of potential for a good amount of upside. So overall, the first metric I look at when doing financial analysis is revenue growth. This, I'll say, must be positive 98% of the time. So I'm going to look at historical revenue growth. Okay, so this is NVIDIA. Obviously, we have good revenue growth. Estimates, they're expected to continue to grow, even though it kind of slows down this year, right? So let's say they get the check mark for revenue growth. I like to find high growth companies that are expected to grow revenue more than 10% over the next 1 to 2 years, which is in line with my time horizon. So a lot of the companies on my watch list, they're going to have that high growth rate for revenue. I don't need to be invested in low growth companies unless there's some very specific, compelling reason I should be buying that stock. In general, looking for good growth is a way for me to rule out companies that perhaps don't even have a chance of beating the markets. I mean, besides, who doesn't want a company to grow their revenue? So that's pretty important to me. But perhaps more important than revenue, I look at profits. I pay closest attention to EBITDA and, as I mentioned earlier, free cash flow. I view EBITDA as sort of a proxy for a company's earnings and incorporate it into my valuation. This is what nearly all investors do, private equity and the markets in general. Free cash flow is the most important metric for me. Unlike net income or earnings per share, which are typically manipulated, free cash flow actually represents the cash the company is generating that is available to shareholders. The simple question here is the company making money or will it in the near future? If not, I don't even want to look at them. Well, I'll say, again, 98% of the time. I think this is another good way to filter out companies that say don't deserve my investment. If you look at the stock price performance of all the IPOs and the SPACs that occurred over the past few years, which I'm sure you'll find plenty of examples, that will demonstrate why I rule out these companies from the start. I use both free cash flow and EBITDA to drive the valuations, specifically the companies that I'm looking at on my watch list. Another thing I'll look at is operating income. I like to use ROIC.ai, and because it gives me a long-term picture. Ticker kind of limits you. So ROIC.ai gives you basically the company's entire history. So something I'll look at, I'll go to financials, and then I'll look at operating income right here, and I'll look at the margins. As you can see, Cisco, I wouldn't say it's a deep value stock, right? But Cisco seems pretty interesting. And if I look at the operating income, it's pretty solid. It's pretty steady. Most of the time, it's above 20%. So looking at this trend, I would say they have pretty consistent earnings. Not bad. There might be a company that just by looking at their operating income over the past, 5-10 years even, it's all over the place, the cyclical stocks. So that's something I'm pretty cautious of. And I do want to see a decent long-term trend. Overall, this will tell me if the level of profit that the company is generating today can be reasonably expected in the future. It's really helpful when looking at cyclical stocks that maybe look attractive based on initial valuation, but based on supply and demand, or perhaps where we are in the industry cycle, those stocks aren't going to continue to make the same level of profit in the future. So that's why I find just looking at the trend of operating income to be pretty helpful. Another very important thing to look at is a company's debt. I always look at debt. I think every investor has to pay very close attention to debt. As with every other investor, I'll compare debt to EBITDA, debt divided by EBITDA, to see if a company has too much leverage. Typically, I'll look for companies that can get to under 3 times debt to EBITDA over the next 1 to 2 years, even if it's currently much higher. I'm very cautious of companies with high debt, as those companies could be destined to go bankrupt if the business doesn't do well. At the same time, if a company has high debt today, but is well positioned to cover that debt in the future, maybe given a catalyst, the stock could very well be a multi-bagger. Overall, I want to know that the company will have the ability to service its debt and have some free cash flow left over for either reinvestment or dividends or share repurchases. It's very hard to do any of that when all of the company's free cash flow or all the company's cash flow has to be used to repay debt. Other financials I look at include current assets and liabilities, and current liabilities, which give me an idea of the company's liquidity, preferred shares. I typically avoid companies that have preferred shares, and book value. Also, in some cases, tangible book value. I won't go into detail on those today, as I typically just use them as references in support of my financial analysis or valuation. Last thing I'll point out about financials is it's important to look at trends, just like I mentioned with operating income. I'll often cross out stocks based on poor historical trends, even if their financials look decent today. Not only that, but trends that are just starting or expected to begin soon should be considered when looking at historical financials and projecting financials as well. If I'm expecting a change in a trend, it's only because there is a catalyst I'm expecting to occur, not simply because I think it's going to happen. Once I've done my financial analysis, and that's more or less, that's it. I'm going to go back to valuation. So now I have a good understanding of, or a decent understanding of financials. I have an idea of what the company's projections are by looking at ticker.com. I'm going to go back to valuation, and I'm going to use those projected financials that I've gotten from this website. I'm probably going to go somewhat conservative with, and I'll apply them to the multiples to come up with a forward valuation to see what I can reasonably expect the company to be worth at some point within my 3 to 24 month time horizon. So yeah, I'll use ticker.com, but like I said, I'll often adjust the estimates to be more conservative, especially when there aren't too many different sources of estimates, and it'll show you when you hover over the estimates here. So estimates for revenue, 42, estimates for free cash flow, 12. Some companies, they're only going to have a few for free cash flow, or maybe even one. So those I'm going to take with a big grain of salt. So once I look at those, I'll incorporate them into the multiples such as free cash flow yield, enterprise value to EBITDA, etc., to compare my expected returns between all the stocks that I've looked at. Now, this is where it gets weird for people. My multiples-driven valuation process, it's based on industry standards, but the way I apply it is perhaps somewhat arbitrary. It's not a science. It's just the method that I prefer to use. Because of this, I encourage all of you to do some extra research on forward valuations and decide on a process that makes the most sense to you. Some of you might even want to focus on historical valuations specifically to keep that part simple while maintaining a more qualitative approach in predicting future performance. Use whatever method you feel most comfortable with. My method, maybe it doesn't work for everybody. However, something I think everyone should include in their process, no matter what that process is measuring risk. My preferred measure of risk is margin of safety, which for you, if you don't, maybe you don't like margin of safety, you can also use an expected yield or rate of return, maybe even a number scale, DFV style, whatever makes more sense to you. Overall, the point of applying a risk metric is to compare the value of each risk-adjusted dollar generated between all of the stocks you're analyzing. Put simply, stocks with higher risk should provide higher returns. And if I were to open up my little valuation section here, you could see right here, this is my margin of safety column. A lot of people would say, why do you have 80% margin of safety? Why do you have 67% margin of safety? Some stuff. This is just my preferred approach. So you can you can decide however you want to do this, but I think applying some kind of risk measurement to your valuation, to your stock price targets is absolutely necessary. And overall, I'm not afraid to be very picky with high risk stocks if I find those that could potentially be, big multi-baggers, because if they really are worth as much as I or the markets think they are, I shouldn't need to throw my entire portfolio at them in order to make a solid return. So finally, once I've compared the returns and risks of each stock, I can invest in the companies that are most undervalued or have the highest expected return, rather than loading up on a bunch of stocks that appear undervalued, but maybe they don't compare well to potentially better plays. That's why my list is limited versus all the stocks that are on my watch list that might actually have some decent upside. This is basically, I have some that I still need to look into, some that I'm just watching for now. This is why I'm not investing in all these stocks. And in terms of finding the potentially better plays, a better play means whatever you want it to mean. But I prefer to look for stocks that, as I mentioned earlier, have an asymmetrical reward to risk profile. In other words, they have significantly more upside potential than downside potential. So once I've covered financials and valuation, I'm going to touch on macroeconomics. For me, I pay the most attention to overall trends in the economy, such as GDP growth, interest rates, inflation, and unemployment, as well as the bond markets, overall stock markets, and volatility, which is used as a general gauge of uncertainty. It seems like a lot. However, I never let macroeconomics prevent me from making new plays or from entering the markets at all. I'm mostly referring to these indicators when stocks are trading at relative highs or lows. I will take cues from, say, big insider trading to support a thesis I may already have on a potential play. Maybe the stock price is very low and they start buying, right? But I never try to predict when the markets will crash or rebound. If the markets are crashing and valuations for certain stocks are looking very attractive, I would definitely load up on some shares or maybe even long-term calls. At the end, it always comes back to price and valuation. So considering that the markets are rarely tanking or melting up, I don't let macroeconomics govern my value investing decisions a majority of the time. They're just something I refer to, something I pay attention to, but I'm still investing, I'm still trading. I do pay a good amount of attention to microeconomics though. Mostly supply and demand, almost entirely just supply and demand. This helps me to identify stocks that are potential value traps or stocks that seem to be trading at a bad value, but may do very well given a change in the company's industry, such as a supply chain shortages or a massive increase in demand. Supply and demand is constantly changing and it looks very different across all sectors. So it's something that I research pretty often and pretty diligently. Sometimes the best plays I have occur simply because the market's underestimated changes in supply and demand. Finally, I'll do a bit of qualitative research. So once all the quantitative part is done, now it's time for a bit of opinion, right? First, I'll look at management. What's their track record? If they don't have one, or if they have a bad track record, why would I expect them to suddenly improve? The way I determine this is by reading through earnings call transcripts and simply checking to see if they have relevant experience. This can be as simple as, have they run a company before and does it still exist? I'm inclined to believe that most executives are decent at running a company. Otherwise, they wouldn't be running a publicly traded company. That's obviously not always the case, but my financial analysis will typically rule out the poorly managed companies. So that's why I rely so heavily on quantitative information versus qualitative. So I usually have my answer by the time I start taking a peek at management. Another thing I'll look at is, are there any popular trends? So a good example of this would be, I think back in 2017, maybe 2018, video game streamers started mentioning that they were switching from Intel to AMD Ryzen. Fast forward a bit, AMD stock price soared and they were looking pretty good. And AMD suddenly lapped Intel, So that was something kind of interesting that I didn't notice, until much later, right, in hindsight. But it was an interesting occurrence. So if you can identify changes in trends, in pop trends like that, that might help you, that might support your thesis and might serve as a decent catalyst. And this kind of goes back to supply and demand. So I wouldn't really say this is that qualitative, but you might have to make some kind of a judgment call to find an investment opportunity like this. Another example would be electric vehicle stocks. Before they did an IPO like crazy, all these SPACs, there was a huge explosion in popularity and sentiment. So just another small example. Forget valuations though, right? Overall, trends, they can be difficult to identify, but they can pay off big if you're right. If that's the case, you really don't need a large position to make good money. And as far as it goes to with qualitative research, that's about it. I'm adamant about keeping the qualitative part to a minimum to avoid excessive bias. When you think about it, it's possible to quantify most opinions, just like the supply and demand for AMD, right? As it relates to investing in general. Any opinion that isn't actually supported by quantifiable evidence should be very carefully considered. And perhaps if it relates to a potential catalyst, you should consider it as a cherry on top, which honestly, I can't even think of any real examples. I can only think of times when people got lucky, such as electric vehicles, right? Because valuations, they still don't make sense. And that's about it for qualitative research. Another thing I'll consider is technical analysis, but not in the way that you're probably thinking. The only proven indicators when it comes to technical analysis are price, volume, price support, price resistance, and momentum. And kind of touched on momentum earlier, right? Patterns, all these cup and handles and pennants and whatever, that's astrology. They don't really work over the long term. It's all about long-term technical analysis, focus on the key factors, right? So over the long term, what is the chart telling you and other investors? That example of Pubmatic is a pretty good one. So bring up that price chart again. And this chart is telling me, you know what? Nobody wants to touch this stock and it's not changing. We had this little hiccup back here, what was that, a month ago? And I think that was because of earnings, but then it's just started trickling back down. So to me, this is saying on every increase in the stock price, the markets just want to send the price back down. So maybe there's something wrong with this stock. Maybe it's going to take a catalyst for the stock to start doing better in the future. Otherwise, I might buy in and this pattern just continues. So that's what technical analysis is telling me for this stock. I don't even have to look at insider buying or insider selling, anything like that. I'm already cautious just taking a glance at this stock, right? So overall, it's the long term that I want to focus on. And something important, falling prices are not enough justification to get into a stock. Why would you buy a stock that is tanking when the fundamentals are poor and the markets expect those fundamentals to remain that way? I don't see any reason to buy any stock like that. So don't just buy stocks because the price fell. Overall, for technical analysis, I do want to focus on daily charts. Fact is, only institutions move markets 99% of the time. The other 1% is impossible to predict, and it rarely occurs. And institutions transact based on end of day prices. So that's why I focus on the daily charts. So finally, now that we've covered financial analysis, valuation screening, done all the work, now we can finally get to the thesis. So overall, I have now identified my expected catalysts. What's going to make the stock price appreciate over time, right? And I'm also going to keep track of the company in case something changes. Ideally, those catalysts do occur, and I got a multi-bagger on my hands. At that point, I like to dollar cost average out of a position. If I'm making a ridiculous amount of money unexpectedly, it just happens really quickly, maybe I'm out of the position altogether, right? Another thing is, what's my expected holding period? As I mentioned earlier, I go for 3 to 24 months because it's too hard to predict anything past even a year, right? So why would I try to go further out from 2 years? It's just a little crazy to me. Lastly, part of the thesis that you always have to account for is sometimes the expected catalyst does not occur. This can be difficult to deal with, but as long as your thesis is supported by good, quantifiable information and you're not YOLOing your entire portfolio into any one stock, you should be good to go in the long run. Sometimes I have to call it a day on a stock that isn't moving, or worse, it just keeps dropping because the markets don't care about its valuation. All considered, I trust my process, so overall, the other plays I make should compensate for the occasional loser. That's basically the whole process for me. Now I guess I'll just touch on a few notes I suppose I have. So one thing I would say is try to focus on efficiency. That's why my process is the way it is, because I don't have time to research hundreds of stocks every day, right? Or even every week. So I try to be as efficient as I can. That's why my process is so specific, and I think it's fairly straightforward. Use as many free resources as you can. You shouldn't have to pay for resources. And again, I'll make another video with links to all the sources that I rely on and kind of do a walkthrough of those. Third, there's nothing wrong with basing decisions on analyses conducted by others, or maybe investing in stocks that maybe institutions or hedge funds are loading up on. But you should always confirm. Always do your own research. Always figure out what the big hype is about. This really shouldn't happen too often. Honestly, it shouldn't. So most of your plays should be derived. They should come from your own research. Another thing is leverage if it makes sense. Look at the options pricing. That was how DFE made a killing off of GameStop, right? Even if you just bought the shares, he still would have made a ton of money. But if it makes sense, leverage up. Maybe those options are priced relatively cheap, and it just makes sense to go out, say 9 months, a year, maybe even a couple of years if the options are available, right? So never hurts to add some leverage to a play, particularly when the amount that you're risking is limited to the amount you pay for the options, right? I do have other strategies, but I honestly don't feel too comfortable discussing them, which would include like trading volatility, event-based trades, hedging, some of the much shorter term trades. But I may talk about them if opportunities actually present themselves when I'm live streaming. There are plenty of great sources and high quality videos on YouTube that can help you learn to complement your primary trading strategies. So for those of you who are sad that I'm not going to go too far in depth on those, there are so many sources, and they could probably do it, explain it better than I can. So as a reminder, I think it's typically best to stick to just a few strategies. The most successful hedge funds in the world do exactly that. So if you're looking at a couple, like a dozen different strategies, you might want to tone it down a bit. So especially when you're starting off, just a few strategies, 2 or 3, maybe even 1, So I think it's always best to just stick to a few strategies, and adjust them as you go, get rid of a strategy if it's not working, and replace it with another solid evidence strategy, right? So overall, that's my process. I think that was a pretty good overview. Like I said, it's not a science, but I trust it, and I think I apply a good risk management process to make sure I'm not making any poor investment decisions. So I'm going to include the sources that I mentioned, amongst other sources, in the description down below, and I'll post that other video covering all of my sources and do a pretty detailed walkthrough of everything that I look at, my screening process, and that should be viewed as kind of complimentary to this video. That said, thanks for watching. I'll see you all in the next video. Cheers.